Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Managing Investment Risk, Strategies to Protect and Grow Your Portfolio. Investing always carries a degree of risk, and ignoring it can lead to costly mistakes. The key to long-term success isn't avoiding risk altogether, it's understanding and managing it effectively. Whether you're a beginner or a seasoned investor, knowing how to protect your portfolio while aiming for growth is essential. This video will guide you through practical strategies to assess and control risk, helping you make smarter, more confident decisions with your investments. What is investment risk? Investment risk is the possibility of your investments losing value or not meeting expected returns. Anytime you put money into stocks, bonds, real estate, or other assets, there's a chance things won't go as planned. Markets can change, companies can fail, and economies can struggle. These uncertainties create investment risk. Understanding the types of risks and how they can affect your portfolio is a key part of making smart investment choices. Types of investment risks. Investment risks come in many forms, and each one can influence your portfolio differently. Let's break down the most common types you need to know. Market risk. Market risk is the risk of losing value due to changes in overall market conditions. If the stock market drops significantly, the value of your investments is likely to decline, regardless of how well the companies you've invested in are performing. This type of risk is often tied to economic downturns, global events, or shifts in investor sentiment. For instance, during a recession, most sectors experience declines, even if individual businesses are solid. Credit risk. Credit risk applies mostly to bonds and fixed income securities. When you buy a bond, you're essentially lending money to the issuer. Credit risk is the chance that the issuer won't repay the loan or meet their interest obligations. Companies with lower credit ratings, known as junk bonds, carry a higher chance of default but offer higher yields to attract investors. But if the company defaults, your investment could be lost entirely. Liquidity risk. Liquidity risk refers to how easily you can sell or access your investments without affecting their price. Some assets, like stocks of well-known companies or government bonds, are very liquid. You can sell them quickly without significant price changes. However, other assets, like real estate or smaller company stocks, may not be as easy to sell. If you need cash quickly, you might be forced to sell at a lower price than you'd hoped. Inflation risk. Inflation risk is the danger that rising prices will reduce the purchasing power of your investment returns. If inflation grows faster than your portfolio's returns, your money's value could actually shrink over time. For example, if your portfolio grows by 3% in a year but inflation is running at 5%, you've effectively lost 2% in purchasing power. How investment risk impacts returns. The relationship between risk and return is at the heart of investing. Generally, higher risks are associated with the potential for higher returns, while lower risks might produce more modest returns. For example, stocks are usually riskier than bonds but have historically offered higher returns over the long term. Say you invest in stocks of a new tech startup. The potential reward could be substantial if the company succeeds, but there's also a significant chance of failure. On the other hand, investing in government bonds is far safer, but your returns are likely to be much lower. Risk levels also influence how you balance your portfolio. A young investor might take on higher risks for better growth potential, knowing they have time to recover from losses. Conversely, someone nearing retirement might shift toward lower risk investments, prioritizing stability to protect their savings. Understanding how risk affects returns helps you align your investments with your financial goals and comfort level. It's all about finding the right balance for where you are in life, and being prepared for the unexpected. The principles of risk management and investments. Managing risk in your investment portfolio isn't about avoiding it at all costs, it's about understanding it. Successful investors know how to balance risk and reward by applying key principles that help protect their money while allowing for growth. Let's break down 3 foundational elements of risk management that every investor should understand. Risk tolerance assessment. Before diving into investments, it's crucial to know your own comfort level with risk. Risk tolerance is personal. It depends on your financial goals, age, and current situation. How do you figure it out? Start by asking yourself a few questions. What are you investing for? Retirement, a home, or something else? How much time do you have to reach those goals? How would you react if your portfolio lost 20% of its value overnight? For example, if you're younger and investing for retirement decades away, you might handle more risk because you have time to recover from downturns. On the other hand, if you're close to retirement, preserving your money becomes a priority, so you might lean toward less risky options. Understanding your comfort with risk will guide your investment choices. If you don't think about this ahead of time, you might panic and sell during market drops, locking in losses instead of riding out the storm. Always align your investments with your tolerance, so you're comfortable with the ups and downs. Understanding time horizon. Your investment time horizon, how long before you need the money, plays a big role in how much risk you should take. Short-term and long-term goals require different approaches. Short-term goals, 5 years or less. If you're saving for something like a down payment on a house, taking big risks might not make sense. Volatile investments like stocks could drop in value right when you need the money. Long-term goals, 10+ years. The longer your timeline, the more risk you can afford. Historically, stocks have shown strong returns over decades, even though they experience short-term dips. Think of it like navigating bad weather. If you only have a short trip, you might not want to drive through a storm, it's just too risky. But if your destination is far away, you have time to ride out the worst of it and still get where you're going safely. Matching your investments to your time horizon helps you stay focused and avoid emotional decisions when markets fluctuate. It ensures you're not unnecessarily exposed to risk when you're close to needing your money. Diversification as a risk management strategy. You've probably heard the saying, don't put all your eggs in one basket. That's the essence of diversification, spreading your investments across different assets to reduce risk. Why does diversification work? Different types of investments react differently to market changes. For example, when stocks drop, bonds might hold steady or even rise. Real estate could perform well during periods of inflation, even if stocks stumble. Global investments might balance out weak performance in domestic markets. By spreading your money across various asset classes, like stocks, bonds, real estate, and cash, and sectors, such as technology, healthcare, and energy, you reduce the impact of any single investment dragging down your portfolio. Even within stocks, you can diversify by investing in large cap, mid cap, and small cap companies or choosing funds that track different regions. Diversification doesn't mean your investments won't lose value during a market downturn, it's not a magic shield. But it does help limit big losses by ensuring one poorly performing asset doesn't sink your entire portfolio. Think of it as an insurance policy against the unpredictable nature of markets. Strategies for managing investment risk. Managing investment risk is central to building a portfolio that supports your financial goals while protecting you from unnecessary losses. Risk isn't something you can eliminate, but with the right strategies, you can learn to control it and make smarter investment choices. Let's explore some practical techniques you can use to reduce risk and set your portfolio up for steady growth. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.